Yeah, I think that the 4-year cycles are based on the Bitcoin halving, and the Bitcoin halving was really important for the first 12 years of the asset because we were cutting the amount of Bitcoin that was being cut from the supply was very material, relevant relative to the demand in the market. But right now, you're seeing days when Bitcoin trades $50 billion or $100 billion in a single day. The total amount of the halving and the next halving is going to be 225 Bitcoin. So 225 Bitcoin times even 100,000 of coins, it's $20 million a day is the impact of the halving. And so $20 million isn't a first order impact on a $50 billion a day liquidity. It's not even a second order impact. It's probably a third order issue. The primary drivers of Bitcoin right now are the structural developments in the market.
Bitcoin just closed out November in the red. Ethereum too. After months of anticipation and record-breaking headlines, the market has gone quiet. Prices are mixed, momentum has stalled, and the energy that once felt unstoppable now feels uncertain. AI concerns are rattling Wall Street. Economic anxiety is creeping through the United States. Risk assets are taking hits across the board, and crypto hasn't been spared. Even with a small bounce after Thanksgiving, the damage is visible. Investors who expected fireworks are instead watching sideways movement and wondering what went wrong. But here's what's confusing about this moment. All the pieces are supposedly in place. ETFs are live. Regulations are clearing up. Major companies are stacking Bitcoin on their balance sheets. Institutions are finally paying attention. Everything that was supposed to trigger the next massive rally is here. Yet the price isn't responding the way people thought it would. That gap between expectation and reality is creating doubt, even among people who have been holding for years. Now, Michael Saylor isn't one of them. In fact, he says he's more confident than ever. Saylor laid out exactly why he thinks 2026 will be the year that changes everything for Bitcoin. And it has nothing to do with hype cycles or retail investors piling in. His focus is somewhere else entirely: the banks. Saylor believes we're about to witness something unprecedented. Not another speculative frenzy, but actual structural integration of Bitcoin into the traditional banking system. Banks lending against it. Banks holding it as collateral. Banks building credit products around it. This isn't about headlines or price predictions. It's about Bitcoin becoming part of the infrastructure that powers global finance. Let's hear directly from Michael Saylor for more insights on this issue. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
I think that the exciting developments in the asset class are bank acceptance and credit development in the banking network. So we've seen about half of the large banks in the United States start to extend credit against IBIT in the past 6 months. And a number of banks like Charles Schwab and Citi have announced they're going to start to custody Bitcoin and extend credit against it in the first half of 2026. So I think that the real story in 26 is banker acceptance of Bitcoin, willingness to custody it, trade it, and extend credit against it. And that should catapult the asset class to new levels. Yeah, I think that the 4-year cycles are based on the Bitcoin halving, and the Bitcoin halving was really important for the first 12 years of the asset because we were cutting the amount of Bitcoin that was being cut from the supply was very material, relevant relative to the demand in the market. But right now, you're seeing days when Bitcoin trades $50 billion or $100 billion in a single day. The total amount of the halving and the next halving is going to be 225 Bitcoin. So 225 Bitcoin times even 100,000 of coins, it's $20 million a day is the impact of the halving. And so $20 million isn't a first order impact on a $50 billion a day liquidity. It's not even a second order impact. It's probably a third order issue. The primary drivers of Bitcoin right now are the structural developments in the market. For example, if the banks extend $50 billion worth of credit, right, that dwarfs 20 million a day in the halving. And then when the SEC loosened the restrictions on derivatives trading on IBIT, the open interest in IBIT went from 10 billion to 50 billion in a few weeks. So you're talking about tens of billions of dollars of demand for the asset based upon the embrace of the traditional finance establishment. And so the asset class is being driven by the structure of support in the banking industry and in finance, and a few regulatory changes that are actually enhancing that support for the asset. You're right, we were the first, and then there were a handful, and then about a year ago there were 60, and then there were 120, then 180, and now there's more than 200. Generally, I'm a big proponent of any company holding Bitcoin as digital capital on its balance sheet. I think that's good for the company, and that's good for Bitcoin, that's good for the crypto economy. Our business has evolved from a company that simply owns Bitcoin to a company that issues digital credit against the underlying Bitcoin. So today, we're the largest issuer of digital credit in the world. If thousands or tens of thousands of other companies buy Bitcoin, that will be good for Bitcoin and good for our business, so it's helpful. Out of those 250 crypto asset companies or crypto treasury companies, only a couple are in the business of issuing digital credit. Examples would be Strive, that issued a treasury credit instrument about a month ago, and then Metaplanet, the biggest Bitcoin holder in Japan, that actually just issued their first digital credit instrument. So there's 3 of us that are in the digital credit market. There's probably 200 to 300 that are holders of crypto assets. It's all good for the crypto economy. They'll all benefit. But the exciting thing in the market right now is digital credit. Before November of last year, before the red sweep, there was a lot of uncertainty over the asset class. And so I think a lot of publicly traded companies were afraid to go into space. We have a very supportive administration. The president has designated Bitcoin as digital gold. The Secretary of the Treasury has said we want to be the crypto capital of the world. Donald Trump said we want to be a Bitcoin superpower. So we're the first year of institutional adoption. And in 2025, you got the support of the SEC, the support of the CFTC, the support of the Secretary of the Treasury, the support of the President of the United States. And so normally public companies are very risk adverse. And with all of those supportive moves by the administration, combined with the accounting profession rolling out fair value accounting, which was a very big deal. Fair value accounting means that when you generate gains, you're allowed to mark them up on your balance sheet. And before that point, you could only take losses. You could never take gains. So the accounting was reformed, and the regulators began supporting the asset in the year 2025. And I think that once those two things happened, it became pretty clear that it gave a structural competitive advantage to a public company to have Bitcoin on their balance sheet, because Bitcoin has been growing 50% a year for the past 5 years. And so all things considered, if you're buying Bitcoin, you're buying the world's dominant digital monetary network growing 50% a year. And the alternative would be to hold something growing 5% a year. Generally, public companies will start to buy more digital assets and hold more digital assets on their balance sheet. And I think that Bitcoin adoption is going to spread, and that will be good for Bitcoin, and that will be good for those companies. I think the real story going forward is going to be digital credit. If you think about the perfect product is a bank account that pays you 10% when the money market's offering you 4%. And so if you can offer people 600 to 800 basis points of additional yield over the risk-free rate, whether it's in the euro, the yen, or the dollar, then everybody's reaction is, yeah, I want that. What's the catch? And so I think that the real interesting idea is that digital capital, which is what Bitcoin is powering digital credit, and digital credit is 2 to 4 times more compelling than traditional credit instruments for people that want fixed income.
Saylor says his outlook for 2026 is bullish. But he wasn't talking about retail excitement or hype. His focus is on what's happening inside the banking system. Over the last 6 months, about half of the major banks in the United States have started extending credit against IBIT, BlackRock's spot Bitcoin ETF. That's a huge deal. Banks don't lend against assets they consider risky or illegitimate. For years, Bitcoin was exactly that in their eyes. Now, something has shifted. Saylor pointed to announcements from Charles Schwab and Citigroup, both planning to custody Bitcoin and extend credit against it in the first half of 2026. This isn't mere speculation. It's a structural change. It means Bitcoin is moving from the fringes into the core of traditional finance, becoming something banks are willing to treat like gold or treasury bonds. He made it clear that this is the real story for 2026. Not another halving event, not another wave of retail FOMO, but institutional acceptance. When tens of billions of dollars in credit start flowing against Bitcoin, when major financial institutions begin treating it as functional collateral, the entire market dynamic changes. It's not just about price anymore. It's about Bitcoin becoming embedded in the financial infrastructure itself, generating liquidity and demand on a scale that dwarfs anything retail could ever create. That's what Saylor is betting on. Let's watch more clips from him.
I think this current administration has decided they want to embrace digital assets, digital finance, digital capital, digital innovation, digital intelligence. And so you have a very progressive administration, a progressive set of regulators, and the combination of that progressive leadership with constructive legislation like the Genius Act, which legitimized stablecoins, opened the way for all these crypto exchanges to come public and for the successful Circle offering. I think that, what you want is a set of regulators that want to see thousands of companies launched and see hundreds of billions of trillions of dollars of value created. And, you've either got that or you've got a very regressive regime, which is more concerned about something going wrong, and they tend to damp out all that innovation or block those IPOs. People that are excited about stable coins are focused upon payments technology. How do I move money at the speed of light, or how do I improve the Visa network or the MasterCard network or the traditional banking system using digital technology? The value proposition of Bitcoin is digital capital. It's someone that wants to store their value for the next 30 years. So if you think about it, you don't know of any billionaires that are going to sell everything they own to buy US dollars and put it in a safe. So you don't really have currency. Currency is the dollar competing with capital. Stable coins are digital currency. It's a different industry. Bitcoin is digital capital. Bitcoin is competing with gold. It's competing with real estate. It's competing with public equity, your Mag 7 stocks or your S&P index, or private equity. And people that have always owned those capital assets in the 20th century, and they're thinking they want to own digital capital. Stable coins, on the other hand, they're competing with traditional credit card networks or traditional banking networks, and they're offering people with digital payments technology all around the world. Ultimately, the big winner in the stablecoin movement is going to be the US dollar. Because what it means is that every foreigner will be able to use dollars instead of using pesos, bolivars, rubles, CNY, euros, any African currency, the rand, etc. So the dollar is the winner. The US is the winner. And then the technologists that enable and host those digital dollars, are going to be successful companies. There's thousands of ETFs and there's tens of thousands of public securities. As I was saying, the distinction here is there's a digital finance economy built around proof of stake networks and all of these altcoins. It's a very competitive business, but it's very exciting. A lot of people are interested in it. It's the networks and the exchanges you'll use to tokenize currencies, to tokenize brands, to launch meme coins, to tokenize securities. That's an evolving business. It's competitive. If you're invested in it, you need to be a sophisticated tech investor to understand it. And the future of that business will be largely determined and channeled by the resolution of the Clarity Act, which is the next big piece of crypto legislation that we expect to come in the first half of 2026 at this point. So it's happening. It's complicated. Well, I think everybody in the industry is looking for clarity. They're looking for some clear path forward. How do I tokenize my security? How do I tokenize a currency? How do I raise capital with crypto tokens? What kind of decentralized or digital finance can I engage in? What are the rules of the road? And I think that's what we're expecting to have resolved in the Clarity Act. I think the formation of bank credit networks around Bitcoin is very auspicious. It's very good for the asset class. If banks would not give you a loan on real estate, your real estate values would be lower. And if banks were unwilling to give a loan on a stock portfolio, then that would impair a lot of people that want to invest in stocks. The banks are moving into offering credit on digital assets and especially on Bitcoin. That will be good for the banks. That will be good for Bitcoin. And it's merely an acknowledgement that there's $2 trillion of wealth that is unbanked right now. And this is the banks beginning to move into this new asset class and provide banking services to the $2 trillion of holders. There are very positive moves. There's good positive guidance from the banking regulators right now, directing banks to begin to support Bitcoin. There are really good moves from the banks. They've all announced they're going to begin to custody and hold Bitcoin. That helps. I think there's some positive guidance coming from Basel and the Basel working group that they will start to upgrade the collateral value of Bitcoin for bank balance sheets. That will be very helpful. So I think that all of those things will generally accelerate institutional adoption. Every single month that goes by, there are more large institutions that come out in favor of digital assets and Bitcoin in particular. And every single time one of them announces that catalyzes another to consider doing the same.
Now, Saylor also tackled a narrative that's been gaining traction lately: the death of Bitcoin's 4-year cycle. Analysts like Bitwise's Hunter Horsley and Fundstrat's Tom Lee have argued that the classic boom and bust pattern tied to Bitcoin's halvings is over. Saylor agrees, but says halving just doesn't matter anymore, not in the way it used to. He explained it simply. Bitcoin now trades massive volume every single day, sometimes hitting $50 billion or more. Meanwhile, the next halving will cut the new supply by only 225 Bitcoin per day. Even at $100,000 per coin, that's just $20 million in daily impact. Against $50 billion in daily trading volume, $20 million is basically invisible. It's not a primary factor. It's barely even a secondary one. It's just the usual background noise. According to Saylor, what actually moves Bitcoin now are the big structural shifts in traditional finance. When banks extend $50 billion in credit against Bitcoin, that matters. When the SEC eases restrictions on Bitcoin ETF derivatives and open interest jumps from $10 billion to $50 billion in a matter of weeks, that matters. These are the forces shaping Bitcoin's future now. Not mining rewards or algorithmic scarcity alone, but the infrastructure being built by the biggest players in global finance. Saylor also addressed the explosion of companies copying Strategy's model. When Strategy made its first Bitcoin purchase in 2020, buying over 21,000 Bitcoin for around $250 million, it was virtually alone. Now, more than 200 companies hold Bitcoin on their balance sheets. Some people wonder if that creates competition. Saylor doesn't see it that way at all. He welcomes it. More companies holding Bitcoin strengthen the entire ecosystem. It validates the strategy. It drives demand higher, and widespread adoption is actually good for business. Meanwhile, he believes the next phase isn't just about holding Bitcoin. It's about digital credit products built on top of it. He described a future in which people can earn 10% yields on instruments backed by Bitcoin, significantly higher than the 4% offered by traditional money markets. That's the breakthrough application in his view. Not just owning digital capital, but using it to power credit products that outperform everything else in fixed income. Only a handful of companies are exploring this space right now. Strategy is leading, and Saylor believes this is where the real explosive growth will happen. So the question is Bitcoin about to enter its most powerful phase as Saylor predicts, or has the opportunity for massive gains already passed? Thanks for watching.